Here's what's strange and unique about real estate is that the supply is perfectly inelastic in the short run. So when so many people start to move from California and parts of the West Coast into Utah, they can't build them fast enough. So the demand overwhelms supply and you get tremendous spikes in prices.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. Before we begin today, a reminder, okay, there is a website called wealthformula.com, and that's where you should go if you want to be involved more in this ecosystem of Wealth Formula. Part of that website is a sign up to something called the Accredited Investor Club. If you're interested in seeing deal flow that is not available to the general public, that relates to some of the concepts that we talk about on the show, like real estate and, how to get involved when the cycles are down the way they are and all that kind of stuff. That's where you want to be. So go to wealthformula.com and sign up for Investor Club. Now, speaking of real estate, there is a different kind of real estate that we all, whether or not we're investors of real estate, we're familiar with, and that is homeownership. Homeownership, if you think about it, it's really kind of baked in the American dream, right? Everybody tells you the same thing that, you want to, so you start making some money, you got to buy that house because it's your biggest asset, right? But as a real estate guy, as a guy who kind of focuses on the structural ability of people to create wealth, I'm not actually convinced it makes sense for everyone, especially in your early career. And let me kind of explain that. So say you start making some real money finally, and for doctors, that's often like when you're out of residency. For me, it was like, gosh, not until I was 30. I don't know. I was thinking I was like 33 years old, maybe. I mean, that's it's a long time to be broke for, but yeah, I mean, I did a long surgical residency and fellowship and all that kind of stuff, and that was the first time. But as soon as you start making that money, there's this pressure. It's a cultural thing, right? Where buy a house and keep up with everybody, build equity, feel responsible, that kind of thing, and then and you kind of get wrapped up into that, right? And you want to keep up with all those people that you fell behind from because you were in school for so long, or had been so, you're getting a late start on this whole adult, upper middle class thing or whatever. But here's the part that gets forgotten is the reality is your primary home is not an asset. Robert Kiyosaki talks about that all the time. And specifically, he says that if something takes money out of your pocket, it's not an asset, it's a liability. Well, that describes homeownership for sure, right? According to Bankrate and Census Bureau, U.S. homeowners spend about $17,000 per year just to maintain and operate their homes. And that's before you make a single mortgage payment. Now, many of you are high-paid professionals, and you probably spend a lot more than that. Talk about property taxes, insurance, utilities, landscaping, repair, bills, HOA fees. So if your house is worth $1.5 million, and, I think that's probably a lot of you, even the bare minimum 1% annual maintenance rule hits you with about $15,000 a year just to keep your place from deteriorating. And then you add insurance, taxes, utilities, everything else we talked about, and you're looking, I don't know, another $30,000 or $40,000 per year in unavoidable, non-negotiable carrying costs. And that still doesn't cover the roof that fails suddenly, the appliances that die, or the Mother Nature stuff. The reality is that none of this really feels like an asset to me. Now, to be fair, though, home ownership is not really just what people think of as an investment. Usually, they usually buy them for stability, a place to raise kids, a sense of being settled. It's emotional, it's psychological, and it's all real. It's a quality of life thing. But if you're young, and especially if you haven't hit your first million or whatever, it's worth asking yourself a tough question. Is buying a home right now the best financial move? Or, is that just because it's just the most familiar one? It's the one that everybody says you're supposed to do. the facts are that, okay, U.S. home prices appreciate around 4.3% per year, because listen, you're not up levering these things and making money along the way. So that's what you have to look at it. And meanwhile, if you look at the markets, if you're a stock market person, the S&P, it averages 10% per year. If you look at value add real estate, we typically target 16 to 20% internal rate of return, plus tax advantages. You're not getting any of that if you just have that equity in a house that's trapped in there. So if you're just getting started, it might make sense to delay that home purchase, invest first, try to build some income from your investments, some additional wealth, and then let those assets, help sort of pay for that home or that lifestyle, right? And if you do that, you'll be in a position of strength rather than strain, because that's a terrible feeling to be house poor. And the irony is that waiting often gets you the dream home faster because your capital compounds instead of being trapped in drywall. And it's a better way to do things. It's not being cheap or penny wise or whatever. It's just smart. It's just math. Anyway, this week on Wealth Formula Podcast, we're going to break it down with an expert who digs into this very question and lays out why homeownership might not be the golden ticket that people think it is, especially for high earners. And we will have that interview right after these messages.
Wealth Formula Banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, the strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash-flowing investments. Here's the key. Even though you've borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. As a result, you make money in two places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Dr. Ken Johnson, the Christy Kirkland Walker Chair of Real Estate and Professor of Finance at the University of Mississippi. Welcome, Dr. Johnson. How are you?
I'm doing great. And you?
I'm doing well. You have a very interesting focus of attention, which I'd love to start talking about right now. And let me ask you this question first. Most Americans still see buying a home as the foundation of wealth. Is that a false idea? And I guess the other question is, well, why did we get that notion in the first place?
Sure. So two short questions there, and they're really pretty easy to answer. Yes, homeownership is a vehicle for creating wealth. It's perhaps, though, not the best overall vehicle for creating wealth. Historically, though, most individuals in the U.S. didn't have access to the capital markets. So that's becoming less and less so today. So you can think of it like this. As a matter of fact, myself and a professor named Dr. Ellie Braha, we did a study about 12, 13 years ago. We looked at home ownership and creation of wealth and renting and reinvesting those monies that you would have put into home ownership and which way would have ended up creating more wealth. In other words, so I rent and reinvest, or I own and I build equity. And on average, renting and reinvesting wins, but not by that much. So home ownership is a great wealth creation vehicle if you don't have access to capital markets. If you have access to capital markets, renting and reinvesting might be a little better. Whatever you do, don't do the third option of renting and spending that difference on beer and cookies.
Yeah, sure. Well, so you decided to test that belief in the first place with data, and that led to the question of whether homeownership always makes people richer. Can you talk about that data that you analyzed?
Sure. So we look at a data stream of housing values. Originally, we used old Case-Shiller numbers when we were going back, but in the recent years, we started to use the third-party platforms. Zillow, Redfin.com, Realtor.com all produce segments of data that are essentially repeat sales indices for almost 400 metropolitan areas around the country. And from there, we can predict, given past housing prices, past average housing prices, where we can predict where current housing prices should be, and then we compare those differences. We do that for buy versus rent in terms of a price to rent ratio. We do it strictly in terms of price. And then myself and two other professors, Dr. Biddy Waller and Shelton Weeks, we actually look at rents, where we look where should rents be and compare to where they are. So we run really 4 indices on any given month. And right now, it depends on where you are. The buyer or rent signals are a little different in different areas around the country. It's not one clear picture.
Yeah, I was going to say, I would imagine if you looked at that data, for example, in over the last couple of decades, and somebody in Southern California or somewhere where the prices have gone absolutely mad, that those people would have gotten, those guys probably really outperform any kind of market. Can you talk a little bit about the demographic differences?
Sure. So as a general rule, where you see the demographics moving to, you also see the capital moving to. So there's been significant movement of people and capital from the West Coast, from the Midwest and Northeast. And there's almost a U shape, if you will, that runs through Utah, Colorado, Wyoming, down into Texas, Arizona, going back east, and then back up the East Coast to just pretty much into Virginia. Northeast, Midwest, West Coast have been demographically seeing people move away in terms of the number of people that are changing their locations, and the wealth is following them. So you see home prices kind of follow that, not without, there are exceptions, of course, and depends on where you are. But the demographics solve all real estate problems. If you're having a rapid increase in population, your home prices are going to bounce back. That's for sure.
Right. Does this data, I'm thinking about, there's certainly, when we talk about housing, people buying houses, there's a difference between, the lower ends, the middle end, and the higher ends of housing. How does that all break down?
So we look at trends, but that's absolutely, what you say is absolutely true. But we want to look at a trend. So we trim the data in every market so we can see the general trend. We can't drill down past the metro level as defined by the Office of Management and Budget. So when I talk to you about Los Angeles, I know a lot about Los Angeles as a whole, not as a smaller segments, and not across price segments either. But there's definitely different price performances. Higher end homes tend to suffer less in these downturns. So while all markets say if you're going down, they might be going down, but not as much in the higher end. And that's because of higher wealth individuals can on average withstand a downturn, whereas if you're in the lower end of the income spectrum, you're going to have to sell the house or move on or change for whatever reason. The situation is dependent on the economics as well. So if, for example, you're having a downturn in, Texas, like you've seen in Austin, you've seen a downturn in Austin, well, the higher wealth individuals can withstand this. The lower income strata are going to have to deal with this by moving, perhaps, but it's not always the same per market. And a lot has to do with the delta between what an individual's worth, say total wealth, minus their total debt. So that delta, if that's highly leveraged and the delta is small, then you're going to see real estate prices respond much quicker in that market. When you see a larger delta on average, you're going to see less responsiveness, and the higher wealth individuals will be able to ride out the bad times and coincidentally take advantage of the good times better than, all else being equal, better than the others.
On an individual basis, Dr. Johnson, first of all, I'm looking at this, this rent versus buy question that affects people on an individual basis. And I think it's interesting to point out that I think that, and correct me if I'm wrong, but this is applicable across home prices, right? We're not talking about, typically we're thinking about, well, gosh, if somebody's, going to live in an apartment building versus, if they're going to try to buy a small home. But we're talking about the relative comparisons, even in the super, the higher affluent areas, right? Isn't that fair?
I think that's a fair statement. Yes.
Yeah. And so as a follow up to that, when somebody is thinking about, say, there is somebody who's fairly affluent, what do they do? I mean, at an individual basis, what can somebody do to, look at whether it makes more sense for them individually to buy or to rent?
Sure. So that brings up a really interesting question. So when we invest in the stock market or buy bonds, we're looking at a return. It's an investment good only. Housing is both an investment good and a consumption good. That's what makes it very difficult to price. Additionally, it's a necessary good, even complicates it even more, but that's at the lower end. So we're interested in home ownership from a perspective of both consumption and investment. I think when you look at this from the higher end net worth individuals, you'll be seeing these folks that are a little bit more interested in consumption, perhaps relatively speaking, to those in middle America. It's just going to happen that way. They have a bigger delta between total wealth and total debt. And with that, they're going to be more interested in the consumption. And the consumption component of a home is much more difficult to price. You will see, and it's not my work, but if you look across the research, you'll see that higher end homeowners have larger net worths. In other words, they have a bigger delta between that total wealth and total debt. And they are buying more for the consumption end of the component than just a strict, I need some form of an investment where I'm getting a return.
Right. And there's also the other confounding factor, I would imagine, and maybe this rolls into your issue of consumption, is that there are often a lot of sort of hidden costs associated with buying versus renting. Can you talk about trying to weed through some of that?
Sure. Some of the highest costs that we don't think about when we own, although we do cut down on risk, and also I think that's come back to consumption, is the fact that there's the opportunity cost. So think about having 50%, 100% of your home paid for. This is the opportunity cost. You've actually taken capital out of play at higher returns to put it into something that perhaps, yes, you see it as a form of an investment, but it's also partly consumption. And I think that's why many people end up paying for their homes when they can, because there's an old saying, and that is you can't go broke if you don't owe money on it, right? So it's hard for the lender to come get your home and you don't really care, right? You want to be able to have no debt on your home. It doesn't make the typical financial sense if we argue at it from leverage and returns and maximization of returns. I think most people, this high-end level, are looking at, I have high net worth. I'm looking at both consumption and the investment side of the component, but very often the consumption wins. And the investment is I can be safe and I can own this house outright. In many states too, your homeowner, the home that you live in, you are actually, if you've homesteaded the home, you're actually protected against lawsuits and other things that are out there. Divorce cases will protect your position in terms of a homestead. So you can protect a significant portion of wealth by having a paid for home. Doesn't strictly still make it a good financial decision, but that's a form of insurance. So you're going to see as you move higher and higher and higher in price, no matter where you are in the country, you're going to see a greater and greater percentage of those homes that actually have been paid off or have minimal loan balances.
So you've been studying decades of housing data, and I guess one of the questions, if you go back into history, we hear in the news right now about home affordability is such a major issue. What were some of the major turning points in American history and that have shaped basically, these returns and perhaps shaped our entire perspective of homeownership in the first place? I mean, maybe they're not the same assumptions to use anymore.
Sure. Well, I think if you go back, the first major critical change that that happened probably in our parents' lives, or at least when they were young children, was there was the old saying, they don't build them like they used to. Yeah, because they all used to fall down. But when Fannie and Freddie and FHA and VA, when these loans first started coming out, we had government backing of the lending process, and the lending process became a little bit more standardized. Not that the government was making the loans, they just stood ready to help form a secondary market. The lenders then also required better quality of building. So this all happened right before and right after World War II. That's a critical moment in time. And that's from that point where we started to see home prices pretty much only appreciate. The next thing is we've seen significant growth in our population in the U.S. across that span of time. And so as our population grows, as we form households, it's a scarce good. We're just historically haven't been building fast enough to keep up with the population. So as we build, population grows, we occupy the homes, there's high demand for the homes. There's high demand. There's also a trade-off between roofs to live under and rent and roofs to live under and own. But no matter what, we have a growing population. So now come forward to where circa 6, 7, depending on where you were in the country, then we have this crash in housing driven mostly by, we loaned pretty much everybody too much money or too friendly of terms. Builders, we had a belief that builders went out and satisfied that home prices only grow to the sky. We could never have too many homes. When in fact, we ended up with a significant oversupply of housing by 06, 07, when that market turned down, there was this oversupply. So then we're starting to get to hit from a foreclosure crisis, a downturn in the economy coming in around 7 and 8, depending on where you were again in the country. Home prices started down and there was nothing to catch them. Oversupply, bad economy, nobody wanted to buy, depending on where you were in the country. These markets all bottomed out. We follow the top 100 markets by population. Nothing magical about that, just by population. And so when we look at these markets, the bottom always appears around 11, 12-ish. All right. So what happened during that time was we lost so many of the small builders in the country. We lost tens of thousands of small builders, and they've just not come back. So we're dealing with that problem still today, where we have a chronic shortage of roofs to live under. Although we seem to be making a comeback here, especially in the multifamily housing, is helping provide roofs to live under, doors to live behind. So here we are today, and many people, we're experiencing overpricing in many parts of the country, and many people are expecting a crash because that's what it did last time. Housing does follow a cycle, but the last cycle was a tsunami. Typically, that's very atypical. This time around, we've already seen the crest, the peaks of the market were far less dependent. All around the country, nobody got as overpriced as they were 15, 16, 17 years ago. The downturn has been far less. Generally speaking, because we're short of housing now, what we've seen, Buck, is that prices have kind of gone flat, if you will, lateral, rather than increasing or decreasing. They've gone kind of lateral to the timeline. Therefore, the trend in prices is catching up to actual home prices. We'll get back on that long-term pricing trend. So the likelihood of a crash is near zero this time around. But what we're going to face instead of a crash will be affordability issues. Both rents and home prices oscillate around a trend. And so they're mean reverting. It's what makes it so easy to statistically model them, but it's hard to explain. People see this trend, but those are kind of the path. That's the path of how we got here over the last 100 years. I think our greatest threat to home prices will occur after you and I have left this planet, but sometimes in the foreseeable future, if our population begins to shrink, just like many other parts of the world, Italy is a prime example, we will stop having that engine that makes home values grow. And if we have a decreasing population, we're going to need to worry about home prices.
The affordability issue itself, doesn't that create sort of a downward pressure on price? I mean, I think what you're saying is yes, it does, but not enough to create some kind of crash. Is that right?
That's correct. And so we've all got backgrounds in finance or training in finance, and we're watching investments, and we expect our homes, or we expect real estate to perform very much like stocks. Higher rates, lower prices, lower rates, higher prices. And it just doesn't work that way as quickly. Real estate is a financial asset, just like a stock, but it trades in slow motion. And because of that, and human emotion around that consumption investment, human emotion or aversion to risk, we get slightly different results. We see home prices become sticky downwards, not that they can't go down, but they don't respond as fast as we think they will to higher and higher rates. When rates go down, there's nothing to stop them from being sticky upwards. So we tend to see lower rates boost prices. So we tend to be a little hot, if you will. So our peaks are a little bit more than our troughs if you look back through time.
I'm curious, just in terms of historical, you've made this comparison, today's Florida to California in the 50s. Can you talk about that?
There was significant growth in California after World War II. There always had been, but it exploded exponentially after World War II for many reasons, from weather to economy to everything. People were going to the West Coast. Now, I said this about Florida. I also have said this about Texas. In recent years, you've seen this huge surge, and we'll deal with Florida. So you've seen this huge surge into Florida. Now, I lived in Florida until a year ago, and it was not uncommon in the last few years to see new tags that were from all over the country, predominantly, though, from the Northeast and Midwest. And so you have this significant, huge influx of population. It's changing the entire economy of Florida. Florida was historically for tourism and retirement. It's really hard to retire anywhere Orlando south at this point in time. California saw the same thing, by the way. People were going to go to California and live the good life forever. Well, a lot of people wanted to go to California. And so we're seeing history repeat itself. Florida is slowly pricing itself out of the retirement market. The tourism market will become harder and harder to maintain in the southern part of the state as time passes. Yes, people are going to want to go to Miami Beach, but they can't afford the hotel rooms per night or the Airbnbs. And so the pattern of California, I think we're going to see for Florida, especially because of the retirement and tourism side. I don't necessarily see the same pattern for Texas, but I do think there's going to come a time where you'll see the retirement market move, if not out of Florida, at least up into the northwestern panhandle of Florida. And you'll see retirement communities developing along the Georgia, South Carolina, Alabama, and Mississippi coast. Baldwin County, Alabama, few people know about it, but they will soon. It's a great place to retire. The beaches look like sugar, and the cost of living is very, very low.
Yeah. So those areas in Florida, then, do they become, do they start significantly pricing people out just the way it happened in California at that point?
You're going to see some of that. So we're going to have affordability issues especially in South Florida, like we had in many parts of California. So you're going to see this happen and evolve through time. But one of the things that's also going on in Florida is it's who's moving to Florida. So there's an old website that's gone, and I wish it was still there. It was called How Money Walks. It's disappeared, but they measured the changes in adjusted growth income by county, which counties were growing the fastest in the country or shrinking the fastest in adjusted gross income. And Palm Beach County was leading that. It was number 3 overall in the country. So there's a lot of capital coming in. And in Palm Beach County, you hear a lot about Wall Street South. That's developing. A lot of the financial industry is moving into Palm Beach County and other parts of Southeast Florida. You have healthcare in Broward County. That's the next county down. Miami-Dade is the big new crypto capital of the world. Tampa, Orlando. Still a lot of tourism in Orlando, but you're seeing healthcare markets develop there. Technology in Tampa as well. So you're seeing an economic shift and change in Central to South Florida. That's not happening as much as in the northern part of the state. A lot of that's going on in Texas as well. But you're seeing a recovery right now in the Northeast. So we measure the most overpriced cities in the country in terms of we can predict where prices should be, and we look at their actual prices. And 7 of the 10 most overpriced cities in the U.S. are actually in the Northeast and in the Midwest. So there's been a resurgence in people wanting to move back. And we've already seen that. But I don't think people are going to play ping pong back and forth between Florida and the Northeast corridor of the country. But you're actually seeing now a resurgence in the demand. And prices are really good in places like Philly, Detroit, even though they're very high in Detroit relative to where they should be. Prices are really good. Same thing for Cleveland. So you're seeing parts of the country that people are not only moving back to, but perhaps like we saw for generations, many people that lived in rural areas are not making their first move to Florida now. They're making their first move to Philadelphia, for example.
What are some of those markets that are really overpriced versus, I guess, underpriced right now?
So when we look at the top 10 most overpriced markets in America right now, we look at their prices, where they are, and compare them to where they should be, statistically modeling them. We're seeing the most overpriced markets are Detroit at 33.5%, and then falling in descending order of Cleveland, Ohio, New Haven, Connecticut, Akron, Ohio, Worcester, Massachusetts, Las Vegas, Nevada, Hartford, Connecticut, Rochester, New York, Knoxville, Tennessee, Toledo, Ohio.
These are overpriced. These are overpriced.
Overpriced markets.
That's sort of counterintuitive, isn't it?
Absolutely. But yes.
Wow. Okay. And then how about the underpriced markets? I'm curious on that too.
Sure. So when we then go to the opposite end of the spectrum, and usually now with underpriced comes risk, and there's risk in both of these markets. What you want to do, both overpriced and underpriced, what you want to be long-term in a housing market, though, Buck, is you want to be really close to that trend and not have these dramatic swings. It's just like stock price. We don't like volatility in housing. It's dangerous for performance. The most underpriced markets, we only have 4 markets in America right now that are trading at a discount relative to their long-term pricing trend. In other words, statistically, where they historically prices say prices should be today, only 4 cities are underperforming that. That's Austin, Texas at 3.1% below where they should be, or a discount of 3.1%. San Francisco at a discount of 6.5%. New Orleans, Louisiana at a discount of 8.7%, and Honolulu, Hawaii at a discount of 10.3%. Notice I'm not saying these markets are inexpensive. They're just below where they've historically been. These are the best buys right now because they're below their long-term trend.
Again, extremely counterintuitive when you bring in some, a place like San Francisco, which is extremely expensive, but very, very counterintuitive. It's fascinating. So it seems like the more secondary tertiary markets are actually the ones that are overpriced, which is, what is there general reason for that?
Well, I can give you a very general reason. The demand is outstripping the supply, but now what's behind that part gets really difficult. A number of us are talking about this, so there's no real data. It's anecdotal. We think that a lot of resurgence in places like Toledo and Cleveland and Detroit is, yes, some few people are moving back from, say, where they've migrated into Texas or the no income tax states, Tennessee, Texas, Florida. Some few of those are going back. You're still seeing people leaving rural areas and moving into cities. And so if I'm in middle America and I'm looking to not be in a small hometown any longer, and I'm looking for financial opportunity, perhaps I make my first jump to Detroit as opposed to moving to Miami, Florida, right? And so we don't know that, though. The demographic data comes out so slowly. But yes, we've been very surprised because this overpricing has developed in mostly in the Northeast and the Midwest in the last 6 months. So when you look at our data month to month, you don't see significant price changes or ranking changes. But if you look at it every 3, 6, 9 months, it's like, wow, the world looks a lot different than it did 6 months ago. 2.5 years ago, the most overpriced city in America was Boise. I became the most hated man in Boise, Idaho there for a while, but now it's the 83rd most overpriced. So just in 2 years, that market changed pretty significantly. People are still moving in. The marginal change, though, here's what's weird about strange and unique. Let's don't call it weird. Strange and unique about real estate is that the supply is perfectly inelastic in the short run. So when so many people start to move from California and parts of the West Coast into Utah, they can't build them fast enough. Or into Idaho, Utah, that northwest part of the country. When people move there, you can't build them fast enough. So the demand overwhelms supply and you get tremendous spikes in prices.
When I think about it, it actually does kind of make sense, because what you're looking at is you've got these markets that may be inexpensive, but that's the reason there's more demand there, right? And that's why, relatively speaking, they are they're more expensive for what you would expect in that area.
Relative to where they should be, but not more expensive in absolute terms. I think you're 100% right. Other parts of the country that would surprise you, myself and a couple other guys decided to follow the housing markets and the SEC schools. And I'm sure if we expanded beyond that to the ACC, Big Ten, if you looked at university towns, we look at the SEC, we're in the SEC, and you're seeing significant growth in all of these markets. And you notice Knoxville was in the top 10 most overpriced cities. So you're seeing significant movement in this world where not all, but many can now begin to work from home and actually have significant incomes. They're deciding to go do that at their alma mater or a nice university town. So it's a different way of life. And I think that's going to continue. So I don't know where this ends up, but if I was a smaller town in America, I would be looking to increase my infrastructure in terms of internet availability, how much the bandwidth. I need a big bandwidth for my hometown so we can grow and attract people in. And I think you're going to see more of that, but still the cities are going to grow. I think you're going to see people 20 years from now, we'll still be talking about how many people are leaving rural America and moving into metropolitan areas because they're following the potential for economic growth.
When you look at all the data that we've been talking about, obviously this relates to a person who is living in a home that they purchased or renting a place that they're going to live in. How does this data translate to investors in real estate?
Sure. So one of our other indices, we call it our price to rent ratio. It's really a PE ratio for rents versus home ownership. And then so we can look at that. So if you're in our 100 markets, we know the average price, right? So it's going to be price divided by the annual average rents. So it's going to be how many dollars in price do you pay for every $1 in annual rent? And that gives us the relative difference between owning and renting. The higher that ratio, the more you should, in general, be leaning towards renting. The lower that ratio, the more you should be leaning towards owning. And we used to do an old buy versus rent index for 23 cities. We now do it for 100 cities. And this price to rent ratio produces almost the same exact answer. So when we look at the average price to rent ratio in an area, and we just compare, are they above, or currently, are you above the price to rent ratio for Los Angeles, California, or are you below it? If you're above that average for, say, the last 10 years, you're going to be rent friendly. If you're below it, you're going to be buy friendly. I can do this very quickly if you want. I can pick a California market you'd like to know about. But
a city?
Yeah.
Well, why don't we use mine? Santa Barbara, California.
Santa Barbara. Let's see if we got you. Is it in the largest 100 metros in population?
Probably not.
Okay. Well, yeah, I don't see it. I don't.
Okay. Well, let's try. Why don't we try Dallas, Texas?
Okay. Dallas, Texas. That one's in the top 100 in terms of population. So Dallas, Texas, right now, their price to rent ratio is at about just below a 6% premium. In other words, that trade-off between renting and owning is about 6% above where it should be, so it slightly favors renting. I'll jump to the next index. If we look at actual prices in Dallas, they're at a slight premium. So it's telling me, hey, that my price to rent ratio is high, slightly favoring ownership, but it's probably because prices are a little high and they might change. Dallas is at a bit of a premium right now, and I'll bet you so I will now go look at Dallas rents. My gut feeling is they're going to be below average. And they are. They're at about a 4.5% discount. So that's just market dynamics in motion right there. And we can do that for 100 cities pretty quickly.
Mm-hmm.
So Dallas prices, that price to rent ratio, it slightly favors renting as opposed to owning. If I could mention one city really quickly, that is just, it jumps off the page every time we do this. New Orleans, Louisiana right now, they're at a price to rent ratio of 15% below where they should be, but they're also at a deep discount. So something really strange is going on in New Orleans right now.
15% discount to what? Sorry, can you explain that one again?
Their price to rent ratio is 15% below where it historically has been. So the average price to rent ratio in New Orleans has been 15.3 to now it's at 13. We're 15% below where we should be. New Orleans is just screaming for home ownership, but home prices right now in New Orleans, they're significantly below as well. I can look that up very quickly. New Orleans currently is at about a 8.79% discount. So prices are down, but they're moderating, and they're probably going to move back towards that trend. New Orleans is a risky market, but you don't see markets fall 15% below their price to rent ratio. Imagine a PE that was 15% below where it should be. That's a stock high. So it's risky, though. That stock that you would want to buy, it probably comes with a lot of risk. But New Orleans presents some pretty unique investment opportunities at this point in time.
Yeah. So for an investor looking for, the ability to raise rents, how would you use that exactly?
So if I'm looking at an ability to raise rents, I'm probably not looking at a metro that has a price to rent ratio at a discount that's below where it should be, because boy, it's just screaming by. You're kind of spitting into the wind at that point in time. So you want to look for markets that have an upward trend or stable, or at least a flat trend in home prices and rental prices. And you want to look at one that has a premium in the price to rent ratio. I'm trying to think of a city.
Yeah, what would be a good example? Maybe somewhere in the Southeast,
probably. So let's look at just out of curiosity. That's a unique question. So let me look at Knoxville. I'm thinking Knoxville or Charlotte are probably going to fit that bill.
Charlotte probably is.
Yeah, let's look at Charlotte. Let's look at Charlotte. I'm closer there. Charlotte, North Carolina, the price to rent ratio is at a 10% premium. When I look at home prices in Charlotte, you want home prices are going to be propped up by rents, by the way. So higher rents usually lead to higher home prices as your alternative option to own, as opposed to renting. But we're going to look at Charlotte, North Carolina. Home prices are currently at a premium of 21% and have held pretty steadily even through this downturn. If I go back 3 years, they were at 27%. So they haven't come down that much. If I look at rents in Charlotte, North Carolina, they're a little bit of a discount.
Mm-hmm.
So, but I think there's a chance to rise.
I guess that's, as an investor, you would look at that and say, well, with the ownership premium there's a upside on the rent.
Yeah, absolutely. So what I would tell you, so our goal when we set out to do this, Buck, every time is just to help people make more informed decisions. So we want to provide for them a lot of data to look at as an open source. So we actually work with 4 different indices right now. We do prices, we do rents, we do the price to rent ratio, which is the buy versus rent trade-off. We also do an inflation adjusted. Now, as an academic, those are wildly interesting to me. I don't think it's as appealing to the consumer, though. But there are 10 cities right now. By the way, New Orleans was perhaps the worst, but there are 10 cities in the U.S. that's 2025, after you adjust for inflation, they have lost value on average. So they weren't wealth creating at all.
Yeah. Interesting. This is all really fascinating stuff. Is this stuff available for anybody to take a look at and play with on their own?
Absolutely. So the American Real Estate Society, ARES, houses two of our indices. So it houses the Waller, WALLER, Weeks, WEEKS, and Johnson, JOHNSON, rental index. So if you just Google American Real Estate Society, Waller, Weeks, and Johnson, it's going to pop to the top of your search. Also at the American Real Estate Society is the Baraha, which is hard to pronounce and even harder to spell, but it's BERACHA, Baraha and Johnson Housing Ranking Index, BERACHA Johnson Housing Price Index, ARES. They're going to find that. I'll send you the links if that helps.
Yeah, we'll put them in the show notes.
Sure. And then probably the next one, the price to rent, really helps you on that buy versus rent decision. That's me and Ellie Braha. Again, we do that rental price to rent ratio, which is really buy versus rent. I'll send you all the links.
Yeah.
People always trip up on Ellie's name.
Yeah.
They want to call him Baracha, but it's Braha.
Dr. Johnson, thank you so much for being on Wealth Formula Podcast. This has been a fascinating interview.
Buck, I've enjoyed it, and I'll send you the information.
You make a lot of money, but are still worried about retirement. Maybe you didn't start earning until your 30s. Now you're trying to catch up. Meanwhile, you've got a mortgage, private school to pay for, and you feel like you're getting further and further behind. Now, good news, if you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator, and it can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you. Check it out for yourself by going to wealthformulabanking.com.
Welcome back to the show, everyone. Hope you enjoyed it. Just another reminder, we have just, 2 weeks left in this calendar year. If you're looking for things that might be able to help you mitigate taxes, investments, that kind of thing, you better act quickly. If you haven't done so, make sure you sign up for Accredited Investor Club. And when you get in there, reply to me. And if you're onboarded as an accredited investor, let me know, and we will find something for you to look at as soon as possible. It's the end of the year thing, so think about taxes and all that kind of stuff. So that's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off. If you want to learn more, you can now get free access to our in-depth personal finance course featuring industry leaders like Tom Wheelwright and Ken McElroy. Visit wealthformularoadmap.com.